What's up, y'all? It's Nate. In this video, I'll give you a quick synopsis of FHA loans that will help you decide if it's the right product for you so that you don't unnecessarily waste your time or your money. Now, despite what you may have heard, FHA loans aren't just for first-time home buyers. And using an FHA loan doesn't necessarily mean that you're not a well-qualified buyer. You know what does give FHA a bad name? Bad lenders. I said what I said. Let's start out with some pros and cons of an FHA loan. What makes it different from other products? Then I'll go over some characteristics of a borrower that is an ideal candidate for an FHA loan. All right, so here are some pros and cons. First of all, it's got a lower credit score requirement. Like really low. The minimum score needed for an FHA loan is 500. For some perspective, the minimum score required for a conventional loan is 620. But don't hear a minimum score of 500 and think that you can call any lender and buy a house if you've got like a 507 credit score. The minimum score is set by HUD, but a lot of lenders require higher than a 500 credit score for an FHA loan. Very generally speaking, most of the lenders you'll talk to will require anywhere between a 580 and a 620 credit score for an FHA loan. And as with most lenders and most products, the lower the credit, the higher your interest rate will be. Now, it is a good option if you do have a lower credit score, but don't automatically assume you have to have shaky credit to be an ideal FHA borrower. There's a lot more at play here. Another pro is the maximum loan to value, or LTV, is 96.5%, which means it's possible you may only have to put 3.5% down. That is a huge selling point for first-time home buyers. According to NAR, the average first-time home buyer puts about 6% down. And there's still this massive misconception out there that you have to have 20% down to buy a house. That could not be further from the truth. Now, you can put 3.5% down on townhomes, some condos, and even duplexes, which means theoretically you could buy a duplex, live in one side, and rent out the other. Use that rent that you're collecting to pay your mortgage, and you can almost live mortgage free. It's a really good way to house hack and start investing in real estate. Third pro for FHA loans: higher debt to income limits than conventional. At the time of filming this video, the maximum debt to income ratio for FHA loans is 57%. Now, keep in mind, to push that limit that high, you're going to need some compensating factors. Some compensating factors might be you have a little bit of extra money in the bank after you get closed, or you have a good credit score. So it's a very case-by-case basis. But if you have some compensating factors, it's very possible that you can push the limits. And keep in mind, there are no income limits on FHA loans. The fourth pro: FHA loans have relatively low rates. Now, this is going to vary from lender to lender, but generally speaking, if you're below around a 680 credit score, you're probably going to get better pricing on FHA than you would conventional. But again, it's going to vary a lot from lender to lender. Even for folks with a higher credit score, you'll probably get a better rate with an FHA loan. But here in a bit, I'll go over why a lower rate might actually cost you more money in the long run. Fifth pro: closing cost help. This one doesn't get talked about as much, especially in the market that we're in 2022, where it's a really heavy seller's market. But with an FHA loan, the seller can contribute up to 6% of the sales price to go towards the buyer's closing costs and prepaids. For example, let's say that you have a $200,000 house that you're buying. That means the seller can contribute up to $12,000 towards your closing costs and prepaids, which means you'll be bringing less money to the table. We've talked about the good parts of FHA loans. Now let's talk about some of the not so good parts. Number one, mortgage insurance. Every FHA loan will have monthly mortgage insurance, even if you put 20% down. And the only way to get rid of mortgage insurance on a 30-year loan is to refinance, or if you put more money down, say 10% at closing. If you put 10% down at closing, the mortgage insurance will actually drop off after 11 years, but that's only if you put at least 10% down. Remember when I said getting a lower rate may actually cost you more money in the long term? Before you decide on an FHA loan, weigh your options with other products. Depending on your situation, you may be better off going conventional and paying a higher interest rate, but lower mortgage insurance. And keep in mind, mortgage insurance eventually drops off with conventional loans. So instead of mortgage insurance staying on there for the entirety of the loan, you can start saving money after you get to an 80% loan to value. With conventional loans, once you get to 80% loan to value, you can talk to your servicer and request cancellation, but they have to automatically cancel it once you get to 78% loan to value. Second con: mortgage insurance. Again, on FHA loans, you'll not only have to pay monthly mortgage insurance, but you'll also be charged an upfront mortgage insurance premium of 1.75% of the loan amount. So on a $300,000 loan, that's $5,250 in upfront mortgage insurance. So the good news is that you can finance the upfront mortgage insurance, but that means a higher loan amount. Something to keep in mind. The third con: loan limits. FHA has a lower loan limit than conventional loans, and that limit can vary from county by county. To find your county's limit, Google FHA loan limit and click the link from HUD's website. I'll drop that link in the description as well. Fourth con of FHA loans: fixer-uppers are probably going to be off limits. An appraiser will be looking for things like wood rot, livability issues, and sometimes peeling paint depending on how old the house is. Other than wood rot, what I see on FHA appraisals the most are electrical and plumbing issues. But if you're the ideal candidate for an FHA loan and want to buy a fixer-upper, ask your lender about an FHA 203K loan. It's an FHA product that allows you to finance the renovation of a house. A future video on that product is coming. But if one of these issues comes up on the appraiser will make the appraisal subject to, meaning that they'll give a value, but that value is only going to be valid if the listed repairs are made. After the repairs are made, the appraiser will go back out to the property and confirm that they were made. Then they'll be okay with the appraisal and sign off on it. Then the lender can close and we can all move forward and move on with our lives. One other thing about FHA appraisals, they stick with the property for 6 months. So let's say an appraisal comes back short of the purchase price and the buyer and seller can't come to an agreement. If another FHA buyer comes along, then they'll use that appraisal and that value for the next 6 months. If you checked out for the last couple of minutes because you were checking HUD's website for your county's loan limit, basically if the house is overpriced or in bad condition, it's going to be a problem with an FHA appraisal. Fifth con, FHA is for primary residences only. And if you have an existing FHA loan, it can be hard to go and get another one. Now it's not impossible, but not every lender will do it. Now if you plan on wanting to buy a condo to live in full time, using an FHA loan works a little differently. When you buy a condo, your lender needs to make sure that that condo complex is on the FHA approved list. If you Google FHA approved condos, you can plug in some information on HUD's website to see if the complex you're wanting to buy in is approved or not. If it's not approved, ask your lender if they will do what's called a spot approval. That allows the lender to get an individual unit approved for FHA financing, even if the complex hasn't been approved by HUD. So to wrap things up, let's talk real quickly about who an FHA loan is good for. Number 1, folks that don't have a big down payment. Remember, 3.5% is the minimum. Number 2, folks with lower credit scores or with a little less credit history. Number 3, if you need a seller concession larger than 3%. 3% is the limit for conventional loans with a loan to value over 90%. So if you're putting less than 10% down and you need more than 3% from the seller, FHA might be the way to go. Number 4, FHA loans are good for folks that have a higher debt to income ratio. If you fall into any one of those categories or a combination of two, it's a good enough reason to look into an FHA loan. Hope you all found this helpful. I'll be posting a lot more content focused on helping you choose the right mortgage for you. So make sure to subscribe, hit the bell, and we'll see y'all next time.